Trump's back and forth on tariffs are unsettling markets and economic confidence, although some think a Trump put will limit any fall in US stocks. Markets now expect more than 3 Fed rate cuts this year, and China sank further into deflationary territory in February. That's coming up in our 5 Things in 5 Minutes on Monday, March the 10th. And then in today's bonus deep dive interview, ANZ's head of G3 Economics, Brian Martin, takes a closer look at Germany's plan to step off its fiscal brake.
It is a huge sea change in terms of fiscal policy in Germany. And I've got to say, one that is much needed.
But first, in 5 and 5 with ANZ, global markets staggered to mixed finishes last week, punch drunk from Donald Trump's toing and froing on tariffs. Here's ANZ head of G3 Economics, Brian Martin, on how changing tariff policies day in and day out is affecting investor confidence.
We have seen a suspension of the tariffs in Mexico back until the 2nd of April. We have seen lifting of tariffs on some goods from Canada as well, potash being one, in use for fertilizers. So there's still quite a bit of uncertainty as to how big the tariffs are going to be, how long they're going to be in place for, what goods are going to be covered. And that's just all feeding into uncertainty at the moment, which is why stock markets have been under pressure recently.
The S&P 500 closed up 0.55% on Friday, but it's fallen 6.1% in the last 3 weeks. The Nasdaq closed up 0.7% and the Dow rose 0.52%. The US dollar index fell another 0.22% on Friday and has fallen 3.5% so far in March. As of 4 a.m. Sydney Melbourne time, the Aussie dollar is at 63.05 US cents and the Kiwi at 57.05 US cents. West Texas oil closed up 1% at 67 US dollars a barrel, while gold fell 0.43% to $2,914 US dollars an ounce on Friday. Number 2. All the tariff uncertainty is starting to affect sentiment in the US economy and may soon affect employment, although it's not showing through yet, says Brian.
We've seen some data, admittedly what we would call soft data, i.e., surveys of business sentiment, consumer confidence, etc., have all been weakening a bit, and uncertainty, particularly trade uncertainty, has been very central to that, as indeed has the government focus on reducing federal unemployment, what the role of the federal government is going to be in the economy going forward. And that, I think, is a very natural response to a change in economic policies which are taking place at present. We did have the non-farm payroll data for February out today, however, and that showed the economy created 151,000 jobs. So that was broadly in line with the market consensus for 160,000 jobs. The unemployment rate remained very low at 4.1% from 4% last time round. So there is no evidence yet in the labour market data that the uncertainty has spilled into weaker hiring. But there are a couple of things to worry about, I think, going forward.
Number 3. One factor limiting the sell-off in US stocks is the so-called Trump put. Here's ANZ Group Chief Economist Richard Getzinger on how markets are reacting to the uncertainty and the idea of a Trump put under the market.
I think markets are right to respond more with uncertainty and confusion than with kind of a definite trend to price tariffs in. And look, there's been a lot of talk about this so-called Trump put for equity markets, that their downside is limited because Trump will reverse course and respond to their signal if they are weak. I get the sense of that, but I don't think it's quite right in the sense that tariffs take the US economy backwards. They may help with some distributional allocation issues, but the US economy cannot be a wealthier and more prosperous economy while really looking only with its own borders without benefiting from what the best of the world has to offer. On that basis, I cannot see how tariffs do anything other than bring future US prosperity down. The equity market must be impacted at some point.
Number 4. Those fears about slower US economic growth are also affecting expectations of the US Federal Reserve actions this year, with the number of rate cuts priced in this year rising from 1 to more than 3 in recent weeks. Here's Richard again.
Certainly tariffs push up prices, but I think with interest rates where they are in contractionary territory, I don't think tariffs will result in ongoing inflation. I think those price increases will kill demand, and that will ultimately bring the Fed back to the table to cut rates.
Number 5. China's inflation rate fell in February to outright deflation of 0.7% from a year ago. That was a deeper fall than expected. Here's ANZ economist Vicky Xiaozhou.
The drop in price for pork and vegetables due to oversupply, combined with a higher base has led to a negative CPI for February. Notably, the core CPI fell by 0.1%, marking the first negative growth since January 2021. Deflation remained a key concern for China. The government has reduced its annual inflation target to around 2% in 2025 from 3% last year. We believe that achieving a 2% inflation rate might still be a challenging goal for China this year. We anticipate that the government will have a more supportive measure to boost the domestic demand.
Vicky Xiaozhou there. Now, in our bonus deep dive interview, ANZ's head of G3 Economics, Brian Martin, takes a closer look at Germany's plan to step off its fiscal brake on government borrowing and spending to borrow 500 billion euros, or 11.6% of GDP, to invest in infrastructure over the next decade.
It is a huge sea change in terms of fiscal policy in Germany. And I've got to say, one that is much needed. You really have to sort of go back 15 years or so to understand why fiscal policy in Germany has been so tight. Europe had a very severe debt crisis back in 2009 to 2011, and indeed for many economies it's built way beyond that. Fiscal deficits were deemed to be unsustainable. And I think Germany, wanting to insulate itself from that turmoil, put in place a very strict fiscal discipline, which limited the budget deficit to 0.35% of GDP. That, however, proved to be very, very tight and very, very restrictive. So public investment fell away. And as we have seen in recent years with all the changes in green legislation, etc., the move away from combustion engines in Germany, that's really been affecting some of Germany's very big industries. Growth has been very weak as a result. In fact, we've had 2 years of very mildly negative economic growth in Germany in 2023 and 2024. And that situation needs to be addressed. Germany badly needs investment. And what we have seen from this proposal is that the incoming administration really intends to boost domestic demand via investment in infrastructure, via investment in energy, via investment in digitalization of the economy. So quite a broad-based investment package across the economy and at different levels from the federal, state and municipalities as well. So it's very encouraging from that perspective, but it's not in place yet, and there is some politics that needs to be ironed out before I think it will pass through the Parliament.
And what might it do for financial markets in Euro? I see that German bond yields have been quite volatile and, at least initially, jumped sharply. So what's the reaction in financial markets?
The reaction of financial markets is growth positive. We saw European equities up, the DAX, put in some stellar performance for a few days. Bond yields, as you've mentioned, rose very sharply. And that's because people are expecting a large growth dividend. The maths are that potentially it could help support the incoming administration's target of 2% GDP growth. It's very big. But I look at the estimates of multiplier effects of fiscal policy in the EU. I think, over 2 years, you could be looking at a multiplier effect of 1, probably greater than 1, which means that for every euro spent by the German government, another one would be created in the economy. So arguably, you could be looking at close to €1 trillion potentially being added to the German economy over 10 years. So that probably equates to about 2% of nominal GDP. Growth may be a bit higher in a low inflation environment. That's certainly going to help support targeting a 2% real GDP growth rate. So financial markets are very encouraged by it.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, March the 10th. Catch you tomorrow with detail on Australia's infrastructure investment track. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.